This is the second part of our series about retirement options. In this video, we're going to discuss IRAs, or individual retirement accounts. In our previous video, we went over employer-sponsored retirement plans like 401k, 403b, and the 457 plan, which you can check out in the description below. Much like that of a 401k, IRAs are basically tax-deferred savings accounts to keep your stocks, bonds, mutual funds, and other assets. In the case of an IRA, however, employers do not contribute to it. Instead, these accounts are opened by an individual at a bank, credit union, or brokerage firm like Robinhood or Vanguard. There are two main types of IRAs, traditional and Roth. There are also 5 other types: Simplified Employee Pension, or SEP, Non-Deductible, Spousal, Simple, and Self-Directed. We'll be going over all 7 of these types of IRAs in the course of this video. The first type of IRA that we'll be going over is the Simplified Employee Pension, or SEP IRA. Simplified employee pensions are retirement plans for small business owners, self-employed individuals, and freelancers. These are generally good for small business owners who want to contribute to their employees' retirement funds. These are best for companies that have a small amount of employees, as they cannot exceed $57,000, or 25% of the total compensation annually. The second type of IRA is a non-deductible IRA. This account is very similar to the traditional IRA, which we'll cover a little later, as the maximum contributions are the same $6,000 or $7,000 if you're over the age of 50 and you don't pay taxes on your capital gains or dividends. But it differs because you cannot deduct your contributions from your annual income taxes. The third type of IRA is the spousal IRA. This account is geared towards the non-working spouse of an individual that earns money and contributes to an IRA for that person. This can either be a traditional or Roth IRA depending on preference and income. This provides a nest egg for your spouse when it's their time to retire. The fourth type of IRA is the simple IRA. This account is much like that of a 401k, which we covered in our previous video, by the fact that small business owners can match their employee's contribution up to 3% if the employee contributes, or 2% if they do not. Employee limit is $13,500 in 2020. The fifth type of IRA is the self-directed IRA. These accounts aren't investing in the traditional stocks and bonds, but rather real estate, a privately held company, or a startup. Basically, you go into the bank and tell them you want to invest in a self-directed IRA, and they'll invest your money in these various places. As we mentioned, there are 2 main types of IRAs, traditional and Roth. Traditional IRAs are the most common type, and they're coming in on our list at number 6. Traditional IRAs are essentially savings accounts that you can contribute money to until you're 70 and a half years old. There's an annual maximum contribution limit of $6,000 or $7,000 for those people who are 50 years or older, which you can actually write off on your taxes each year. There could be limits on those tax write-offs if you also contribute to a 401k or other employee-sponsored retirement accounts, and your modified adjusted gross income, or MAGI, is $65,000 or less, or $104,000 or less if you're married and filing jointly. Many self-employed people choose to invest in this type of account as they do not have the option to invest in a 401k, and you can put your money in this account regardless of how much money you make a year. Earnings on your traditional IRA are tax-deferred, and the only time that you need to pay taxes on them is whenever you withdraw the money. All contributions on your traditional IRA need to be made before the tax filing deadline for the year. It's better to open up and start investing money in your account as soon as possible, as it'll give your money more time to grow and compound, So if you're a millennial and watching this, don't hesitate to start the account to maximize your savings potential. There is a 10% penalty plus income tax payments if you withdraw your money before you're 59.5 years old, so do keep that in mind with this account and try not to withdraw the money before you turn 60 years old. There are a few exceptions to this rule though, like if you're planning to use the money to buy or build a first-time home for you or another family member, if you become disabled before the distribution is due to occur, if you pass away and your beneficiary receives the funds after your death, if you use the funds for unreimbursed medical expenses, if your distribution is part of an SEPP program, if you're using the money for higher education expenses or adopting a child, if you use the funds for medical insurance after losing a job, if your assets are distributed as a result of an IRS levy, if the amount distributed is a return on non-deductible contributions, or if you're in the military and you're called to active duty for more than 179 days. Also, if you have a traditional IRA, it's required that you take out a required minimum distribution, or RMD, each month by the time you reach 70.5 years old. The final type of IRA is the Roth IRA, and it's also quite common. Roth IRAs are perfect for low and middle class workers, as you cannot contribute fully to this sort of account if you make more than $196,000 annually if you file jointly. You can partially contribute to this account if you make more than $196,000 but less than $206,000, and you're completely ineligible for this sort of account if you make more than $206,000 a year. As long as you have owned a Roth IRA account for 5 years, and you're 59.5 or older, you can take out your money, including all of your investment earnings, whenever you please without owing any federal taxes, because the money is taxed when you initially put it in the account. These sort of accounts can also double as an emergency fund for you, because you can take the money out anytime without being taxed or penalized. Except for with your investment earnings. You could be taxed if you withdraw those too early. The maximum contribution limit per year with the Roth is exactly like the traditional IRA, capping you at $6,000 or $7,000 if you're over the age of 50, which you could pay in one lump sum or periodically throughout the year. Like the traditional IRA, you must make your annual contribution by the tax filing deadline. Unlike the traditional IRA, these accounts do not require you to take out a required minimum distribution each month whenever you reach 70.5 years old. With a Roth IRA, the IRS does dictate what sort of funds could be contributed into the account. They must be classified as earned income, so you cannot contribute rental income or other profits from property maintenance, interest income, pensions, or annuity income, or stocks, dividends, or capital gains. To recap, there are 7 types of IRAs, or individual retirement accounts. Simplified employee pensions, which are for small business owners that want to contribute to their employees' accounts. Non-deductible, which is similar to a traditional IRA, but you can't deduct income tax from your contributions. Spousal, which is for non-working spouses. Simple, which is similar to a 401k for small business owners. Self-directed, which is a way to invest in other avenues like real estate for startups. Traditional IRA, which is a contribution that you can write off on your taxes. And finally, Roth IRA, which is sort of like an emergency fund. There are downsides to all of these options as well, as your investments can be volatile. As with anything else, remember to do your due diligence before you decide to contribute to any of these retirement plans. As we stated earlier, this was the second video in our retirement option series. Our next video will cover pensions, guaranteed income annuities or GIAs, and cash value life insurance plans. We hope you find these videos helpful in making the correct decision for your personal retirement, so you can spend your golden years sipping Mai Tais on the beaches of Hawaii. We make videos like this to help everyone like us save money or take advantage of any existing opportunities out there to gain financial freedom. For more videos like this, please like, share, subscribe, and hit that bell to get notified of our latest videos.